Coming up today, stocks put in their best week of the year. Hedge funds continue to sell Nvidia. Consumer sentiment picks up. Trouble in the housing market. Corporate bankruptcies rise. What to expect from Powell next week. Gold hits a new all-time high. And should you take a holiday to North Korea? I've got a real interesting one for you guys. Let's go. And welcome back, everybody, to the best week of the year for the S&P 500. Never feels like it, does it? However, the fact is we're putting in a sharp V-shaped recovery after last Monday's panic low. And just going out to the weekly chart on the cash index, we've just put in another bullish pattern like we've done the last couple of turning points. Looking back in March last year, that was a bit of a piercing bullish candlestick pattern. Then we got the one white soldier, really big Marubozu candle off the October low last year. Got a bit of a bullish harami pattern off the low from April this year. And this is what you could kind of call like a bullish comeback pattern on the S&P 500 index. And just switching over to the E-mini futures, which trade around the clock, an even more bullish pattern. Monster hammer last week. We've followed through and confirmed it this week. The whole mess started last Monday thanks to Japanese stocks. And look at the size of the hammer candle their market put in last week. Big bullish candle this week as well. And so there's the heat map on today's market. A bit checkered across all sectors out there. Wasn't really bullish. All bearish across the board. Saw a little bit of weakness in semiconductors. Same with building stocks and materials. But just switching the heat map over to the weekly performance. Pretty green across the board, especially there in semi. Having a huge bounce. Financials putting in a good week as well. As did healthcare stocks. Some market leaders like Eli Lilly bouncing back with Nvidia. GE Aerospace. Even Boeing finished the week up 7%. As did Tesla and Amazon and Walmart on the back of their earnings. Really good. Softest sector out there at the moment is energy. With REITs having a little bit of a pullback this week as well. Just looking at the market internals, volume breadth, not too bad, 1.64 today. Nice bounce back in the percentage of stocks above their 50-day average, 68%. Still a little soft on new 52-week highs versus lows. But just look at that crush in the VIX index. We're now down to a 14 handle. Who would have guessed that last week? I certainly didn't think so. As I said back then, it was very likely we saw the high for the year. And when the VIX crushes, it can crush hard. But this has been an all-time record for how hard it's crushed. Off a spiking level, not even that 65, just to close above 35 in the following Friday. Here we are at 14. VIX 9-day even lower, 12.9. Option deal is not forecasting much volatility in the market next week, even though we're going to hear from Powell at Jackson Hole. That to me says they're implying he's going to come out dovish and hint at cutting rates next month. But stick with me because I'll get more into that a bit later on. Also show you some conflicting economic signals we're getting out there. And that could be why government bond 10-year has been trading sideways. Still trying to find support here around 385. Good news is we've still got high bonds ripping up, breaking out to 52-week highs again today. Along with the yen carry trade, showing more signs of stabilizing this week. I'll also come back to commodities later. We'll be talking a bit about gold. Just broke out to fresh all-time highs today. And look at that sharp bounce back in high-yield bond spreads versus treasury. Falling off a cliff to start last week. Here we are back above the 50-day. The market's expectations of inflation still trending down. The important sector of semiconductors reclaiming their 50-day this week. Same with consumer discretionary stocks. Whilst we've still got utilities and REITs pretty much sitting at 52-week highs, along with aerospace and defense stocks, pretty much sitting at all-time highs as I speak. So I've pretty much wrapped up all Q2 earnings season, all Q2 earnings reports for mega cap tech, except for one, Nvidia. We'll get that the week after next, and it too, trading above 50-day VWAP. So it's been quite the bounce back, hasn't it, from that maximum fear last Monday. Going into it, we had low volatility for months. All of a sudden, we got a confluence of events. This caused a sharp spike in fear. Japanese yen, Middle East war, Warren Buffett offloading Apple, price jump in the unemployment rate, bond market pricing in a recession, lots of calls for the Fed to step in, and just paying attention to what's led the bounce back. It's been tech, it's been semis, the leader of the pack, Nvidia, still trading really firm going into earning in a week and a half. And you can see why the topic of AI, and whether we're in a AI stock bubble or it's just like 1995, there's good arguments to be made on both sides. That's what makes a market. It's also what makes investing challenging. Just looking at this research note here from Bank of America, they said the AI bubble, not exactly. They think we're just getting started in a third major tech cycle of the past 50 years. With PCs in the 80s and internet in the 90s, I think AI is the big third technological revolution of modern times. We also got McKinsey & Company putting generative AI at the top of their list for 15 technology trends this year. Applied AI coming in number 2, industrialized machine learning number 3, all the way down the bottom, climate technologies, electrification, future of space technology. These are also areas and secular trends I'm invested in and will continue to invest in as well. We've even got Google's ex-CEO Eric Schmidt in a leaked talk to Stanford students saying he thinks they should buy Nvidia. They're head and shoulders above everything else. Basically, the whole world needs their GPUs. However, on the other hand, we've been getting hedge funds form 13Fs, showing they're still a bit divided on Nvidia, if not leaning towards the sell side. Showed you guys earlier in the week, Stanley Druckenmiller, David Tepper, two well-known billionaire hedge fund managers, significantly trimming their stakes in Nvidia, over 80%. We also just heard prominent hedge funds Citadel and DE Shaw have been selling their Nvidia holdings as well. Others like Elliott Management sold all of their shares in Nvidia and warned investors that it's in a bubble and AI is overhyped. They've been getting more into the mining sector. However, we've still got two, Marshall Wace and Rentec, slightly increasing their position in Nvidia. And we've also seen Nvidia corporate insiders offloading big time, especially last month as we're trading up here. You can see all those red circles. Top of the pack, CEO Jensen Huang. He's been selling hundreds of millions of dollars worth of stock. And while sell signals from corporate insiders carry less weight than buy signals, because they could be selling for a number of reasons, not because they think the stock is bad. They may want to diversify their wealth, take advantage of new opportunities, pay tax bills, give to charity, have some personal liquidity, whatever the reason it may be. Could also be they think the stock's overvalued. However, when they buy, it's for more obvious reasons. They like the stock. They think it's going up. It's undervalued. However, it's never a good sign when all you see show up is sale after sale from numerous insiders who know the company better than all of us. Counteracting that, Nvidia's business, revenue, profits, operating margins, and market share, future runway has all exploded with the stock price as well. It's not a complete bubble full of hot air. However, one could also argue that their free cash flow, shown here in the green bars, is also in a bubble. It's very rare a company can maintain 80-90% gross product margins for a long period of time. Competition's bound to catch up. However, that doesn't look like it's going to happen anytime soon. But as long as their free cash flows hold up, stock price has a chance to hold up as well. And this kind of just visualizes the boom in the demand for AI hardware, those advanced GPUs. And that's kind of like lifting the rug on the whole industry. And that could have beneficial ripple effects out to other industries for years to come that turn all their hardware into new products and services. We just heard from Walmart yesterday. The productivity and efficiency gains they're getting from using generative AI. I'm sure every company can stand to benefit from integrating AI. So the actual trend of the technology, its use case, spending, doesn't look to reverse anytime soon, although it could easily do so in a recession. I must admit, it is hard as to what to make of it. Is it like 1995 or is it like 2000? Let me know what your opinion and thoughts on this is. Do you think we're in the third or fourth inning of the AI boom, or are we in the eighth or ninth inning, getting towards the end? And just quickly before I continue on with the daily market review, if anybody interested in purchasing one or more of my product, there's only 2 days left. Pay a one-time lifetime fee to get access to them. As starting next week, I'll be switching over to monthly and yearly pricing so I can better service everybody and better handle the growth. So I kept this open for another week after we had a busy week in market. So if you're interested in getting lifetime access to all my custom trading view indicators you see me use every day in these videos, or if you'd like to get access to my 12-hour online video course, or if you'd like to get all my stock picks and unique research before I make the actual trades in my account, then click the link below this video, head on over to my website, clickcapital.io, and use coupon code LAST25 to save 25% off all my products, including packages as well. It's a one-time fee with no ongoing costs. So like I said, next week, I'll be switching over to monthly and yearly pricing only. So click the link below this video if you're interested in taking advantage of this special offer. Okay, just diving back into the daily market review. We just got earnings results out from two very important large Chinese companies, Alibaba and JD.com, giving us a look at the Chinese consumer and how they're tracking, which did show it's still a little soft. Revenue from merchant commissions and advertising up only 1% from a year ago, and direct sale down 9% from a year ago. JD.com said its average order value declined year over year. They reported soft consumer spending. Same with Tencent. China as a whole reported Thursday their retail sales rose 2.7%, and that's actually a pretty low reading for them, looking back over the last 10 years or so. So still not out of the woods yet for the Chinese economy and stocks. Alibaba did beat a little bit on EPS expectations. Market didn't seem to mind the result, trading up 4.5%, still well off those lows that we were to start the year. Similar deal in JD.com as well. Came in with a beat, stocks up 8%. However, just looking at the sector of Chinese internet stocks, the KWEB ETF, still a bit softer, kind of trading like commodity. However, like we did see some hedge funds pile into these names, David Tepper for one, because they are very cheap. Alibaba, trailing 12-month revenue, 131 billion, market cap, 167 billion. This is like the Amazon of China. And just to compare that, Amazon trailing 12-month revenue $604 billion, market cap $1.86 trillion. So trades at about 3 times sales, whereas Alibaba trades at about 1.1. For sure, American companies deserve a premium. However, even considering that, relatively speaking, still think Alibaba is a lot cheaper, has a lot more potential to come back, and even more so, probably JD.com. $152 billion in sales over the last 12 months, market cap only $36 billion. And so they're an online electronic retailer in China. And when their market eventually turns its head towards Chinese stocks again, as they're inevitably bound to do, we may look back and see $29 a share on JD.com as being quite cheap. However, of course, still full of risk and volatility, still quite likely to be a bumpy road ahead for quite some time. Just moving back to the macro in the States, consumer sentiment picks up for the first time in 5 months. University of Michigan index reaches 67.8, up from 66.4, ahead of Wall Street expectations. Consumers feeling a little bit better about the future, a little bit better on inflation, with inflation expectation getting down to a 2-handle this week as well, just like we saw with CPI. So some saying the economy is doing fine, stop sweating the blips. It's definitely cooling but not crashing. There is a difference. Not every turnaround does have to result in the worst ever recession or depression ever. Truth is, nobody really knows for sure. Not even Jay Powell. Are we definitely going to get a soft landing, or are we going to get the hardest landing we've ever seen in our lives? Anything's possible, and we still do have a number of key downside risks and mixed readings out there in the economy, like the housing market. With housing starts sliding to a 4-year low, high rates are still hurting the market, especially first home buyers, people all around the West with floating mortgage rates. Luckily, a lot of the market in America fixed them really low. Plus, a lot of boomers don't even have debt. They actually benefit from higher interest rates, higher yields from their money market fund. And even though we've got new private housing under construction, diving here in the dark blue line, still got construction payroll, industrial production, manufacturing, data centers, all that stuff is going the other direction. The amount of US new single-family homes for sale, 476,000, that's the highest since February 2008. Getting a bit of glut of inventory out there. And there's now a record 8.5% of US homes are worth 1 million or more. That's more than doubled from just prior to COVID. It was about 3.8%. We've also got 1/3 of home builders slashing prices, confidence in the market falls to an 8-month low. That's builder confidence. They don't like what they see in front of them or around the corner. Whole industry, real estate, can't wait for lower rates. Real estate agents struggling to make transactions. Of course, there's isolated pockets out there in all markets that are still holding up well. However, generally speaking, so there's more downside risk than upside. In a lot of residential housing markets, just looking at valuation and of course the amount of inventory building in the market. And whilst home builders for sure will welcome lower rates, just going out to a monthly chart on the home builders ETF, it's had such a good run off that low from 2022. Like I've been saying, I'm in no rush to add any exposure to home builders in my portfolios. On the other hand, I like REITs. Technically and fundamentally look a lot better than home builders to me. They'll benefit a lot more from lower rates. A lot of them use debt and leverage. Cost of that will come down. Plus us investors, when money market funds go below 4%, we'll start looking across other markets where we can replace that yield, especially boomers. They're enjoying their 5% yields. All of a sudden that starts yielding 3.5%. Might go looking for a few REITs to replace their income. And even though consumer and household debt, whilst is trending up for credit cards, especially for millennials, delinquency rates still not all that bad, especially compared to 2007. One worrying sign we've got is corporate debt. That's still trending up, with global corporate defaults totaling 87 at the end of July, 52 occurring in the US. And that's large corporate company. I think they use a cutoff of over 10 million for the size of the business. So this is not just looking at small businesses. However, counteracting that again is Goldman Sachs. And with all their data and PhD employees, they forecast the US economy to keep growing at an annualized rate of over 2% all the way through Christmas next year. Another thing helping the stock market is companies buying back their own shares. That's expected to be above 1 trillion next year. Not really talked about, but we just came off the back of a really great Q2 earnings season. The median earnings per share growth for their S&P 500 stock, 8% year over year. That's pretty good. The best gains coming in utility. They're on fire at the moment. That's why they're trading so well. You don't normally see that sort of growth in utilities. However, we're most likely in a secular trend for demand for electricity. Financials doing well, and the median energy stock as well, just not market cap weighted. However, contrasting that is we do have elevated valuations. Looking at the S&P 500 forward 12-month PE ratio, what analysts are expecting the market to make in earnings next year, still around 21, pretty elevated looking back in history. However, that's mostly driven by tech stocks who are growing really fast, so you could say it's justified. So it's really a guess and forecast on where tech earnings are going to be over the next year or two. That's really what's going to drive the S&P 500. And the fact is, we don't have many companies citing the word recession on their latest earnings call. And in fact, in the really economic sensitive sector of consumer discretionary, very cyclical sector, No CEOs mentioned the word recession on their earnings call. However, if we're on the cusp of rate cuts, which I think we are, then history does show we should keep a tight leash on risk. More often than not, rate cuts are associated with a contraction in the economy, a contraction in corporate earnings, a contraction in consumer discretionary spending. So I'm by no means ruling out the possibility of a hard landing. Like I said, we've got mixed signals. Soft landing, AI boom, along with recession and stretched valuation in parts of the market. So definitely mindful of that, and we'll get a good taste of that next week. I think Jay Powell's penciled in to start talking 10 a.m. Friday morning from Jackson Hole with their economic meeting. All policymakers could set the stage for the first cut in rates in years, maybe the start of a loosening cycle. Started hiking rates in March 2022 after it became apparent inflation was not transitory. Kept hiking them until July last year. It's been over a year since the Fed has been on pause. And like I said, we got CPI making a lower low, getting down to a 2 handle. And that's what I've been saying ever since last year. We would need to see a new low, a 2 handle, for Jay Powell to get the green light to go ahead and cut. Not only that, we've got unemployment starting to trend up as well. Again, another green light. He can go ahead and cut. Because I'd say the risks now are on the downside for the economy rather than on the upside for inflation. So if I was Jay, I'd definitely cut 25 basis points next month. Can always stay on there for a few months, wait for more data to come in. However, to borrow this good saying from Jay Powell back in 2023, as is often the case, we are navigating by the stars under cloudy skies. And that's a really great way to put it. Economics, like technical analysis, not an exact science. It's kind of a blend of an art and a science done by practitioners. And judging by the price action in the bond market this week, it's a little unsure as well whether to trade weak or strong. It's probably just in a wait and see moment to hear from Jay Powell. But we did get some good economic data this week. Retail sales coming in better than expected. Jobless claims coming in lower than expected. Consumer sentiment better than expected today. However, a little bit weak in housing. Good news for crude oil as well, for consumers and inflation. Finishing the week lower. Got weak Chinese economic data. Their reduced imports for crude oil. Geopolitical tensions receding. Still some indication from the International Energy Agency, which mentioned a likely surplus emerging in the physical market in the quarters ahead. US is pumping it out at records. And for my American friends, thought you'd find this map interesting. Average price for a gallon of gas across all 50 states. Only 2 states, dark red, coming in above $4.50 a gallon. California and Hawaii, not too far behind. Washington, Illinois, Pennsylvania, and New York. Cheapest gas in the country. Mississippi, Oklahoma, and other states in the deep south. There's Florida, $3.32, Texas, $3.03, Colorado, $3.42, Minnesota, $3.35, and most states kind of just around those low 3 readings, with Alaska at $3.71. Just moving on over to commodity. Price of gold, new all-time high, above $2,500 an ounce for the first time ever. A lot of things driving gold higher. Prospect of lower rates, elevated geopolitical tensions, doesn't look like it's going to go anywhere for years. Non-Western central banks accumulating it like they've never done before. Trying to deleverage from the US dollar system. Underinvestment and production for years, like most commodities, tends to swing the other way and hard. And now the market's starting to wake up to it as well. Investors starting to increase their allocations as everyone's watching it going up. And we just marked the 50-year anniversary for US gold futures trading. And a bet on gold is kind of the same as being short the US dollar, which looking back in history is a pretty safe bet. And I'd say it's even more safer now, given the recent history of US government spending, artificial money printing by the Federal Reserve, just creating new dollars at will. Over a quarter of all US dollars in circulation have been created just in the last 4 years alone. It's been used as a currency and store of value by humans for over 6,000 years. It's really nice to hold and look at. And unlike Bitcoin, it doesn't rely on a digital communications network to be transacted or accessed. And there's a look at gold futures on the weekly chart. And as you guys know, some of you that have been with me from the start, ever since early 2023, I've always been advocating for a position in gold. It's great diversification, clearly in a bull market, and we just got another great technical signal breaking out to all-time high. And just keep in mind, we still haven't made a new all-time inflation-adjusted high from way back in 1979. And if we do go into serious war, wherever that may be, or the US does go into a deep, dark recession, gold is probably going to be one of the best places to be across all financial markets. So I'm continue holding long and even adding more exposure. With my next stock pick number 11 that I'll be sending to paid members this Sunday morning, another junior gold miner who in my opinion is really undervalued, has a good dividend yield and still has a lot of catching up to do with the price of gold. So I'll be buying another gold stock come this Monday trading as well. And just to update you on the situation with Israel and Iran. Looks like Iran is recalculating their response. I think they're worried that if they go big this time like they did in April, whether they cause damage on Israel or not, America's pretty much told them they're not going to stop Israel doing a full-scale response, an offensive campaign back towards Iran. In fact, they said they'd even help them, unlike last time in April, from doing an isolated strike next to their nuclear facilities, just letting them know they can target anything inside Iran with a high degree of accuracy. And there's still hopes for a ceasefire deal between the Israelis and the Gaza Strip, with Hamas still holding a lot of hostages. So the ball's still in Iran's court. It's really up to them how they want this to go, but still has the potential to blow over. However, looking at stocks and oil, they don't care, even though gold is still trading quite firmly here. And a little bit of interesting news for you guys today. Cadillac reveals its new Opulent Velocity. That sounds pretty cool, doesn't it? Performance electric vehicle concept car. Designed to preview how the automaker plans to keep its high-performance V-Series vehicles relevant for EV. The Opulent Velocity, Cadillac says, is a balance of ultra-luxury and performance for the V-Series. And it does look pretty cool. There's a look from the back, and there's a look on the inside, kind of like that real minimalist design that Teslas have. Also out, and a bit of interesting news for you guys today, North Korea is reopening for tourism after being shut for 5 years. Anybody interested in taking a holiday to North Korea, now's your time. I, for one, will most likely take a pass. However, I'm sure there'll be some other YouTubers out there taking them up on their offer, and I look forward to watching their videos from the comfort of my couch. As in my opinion, anybody who goes there, even with the best of intention, just like a lot of other countries, you're pretty much gambling with your life, in my opinion. They'll look through your phone, and if you have anything on there they even consider slightly propaganda talking against their dictator and regime, they'll lock you up in a cage for years. So the answer to my question is no, I wouldn't recommend anyone going to North Korea for a holiday. And if you want to see a good visualization of capitalism versus communism, just look at this map of South Korea and North Korea at night. See all the electricity and development in South Korea. Everything's better. GDP per person, life expectancy, and just look at all that economic activity and growth. Even though South Korea has only got double the population of North Korea, about 50 million versus 25 million, even though they're exact same genetics, blood, Japanese used to occupy all of the Koreas for many, many years, up until about the late 1940s. They were then defeated. Soviet Union controlled North Korea, set up a government under the same family that still rules it today. And America set up a capitalist society that's still flourishing today. South Korea, one of the most advanced, fastest growing economies over the last 25 years, while unfortunately a lot of citizens in North Korea have been left behind thanks to communism and a dictatorship. Anyway, that's the way it is. Unfortunately, a lot of millennials, people in my generation, argue for communism and socialism either outright or policies that go in line with communism and socialism. They just took 5 minutes to study a little history. They might think a little different. Anyway, this is the economic calendar to finish the week. There's housing starts coming in a lot softer than expected. Consumer sentiment bit better than expected. Looking out next week, we get inflation data from Canada on Tuesday. Few Fed speakers. Jackson Hole kicks off on Wednesday. Eurozone PMIs, along with PMIs from the States on Thursday. We'll get to hear more from Jackson Hole with Jay Powell going to speak on Friday morning. That'll be the big one for next week. And I'll be paying attention to the price action and bond yields and the probabilities for Fed fund futures. Still about 72% chance they'll cut 25 basis points, which I'd pretty much agree with. I just don't agree with that 27% chance for a 50 basis point cut. I'd put that at maybe 5 or 10%, and the other 20-30% at no cuts. Although I'd say that's a pretty gutsy move for Jay Powell to make if he did stay on hold. I'd say that now is even more controversial than making a cut at the last meeting before the federal election. But that's pretty much a wrap for the daily market review this week, guys. Thanks very much for tuning in with me. I'm interested to hear your thoughts on the market, the AI boom. Is there more downside or upside risks? But all in all, the price action snapped quickly back to risk on, and just that absolute dive in volatility surprised a lot of us. We'll see what we get next week with Jackson Hole and all the price action that comes out from that. Enjoy your weekend away from the screens, and I'll see you guys again come Monday night. Cheers.